always have a portion of your money in bonds. Why? Because it's safe, it's secure, and it's a 99% sure you'll get your money back. Or is it a better idea to invest your money in stocks? For example, dividends. Well, today we're going to find out. Let's check it out. Hey, what's up you guys? Lukas here from excelwealth.com. Great that you're joining today, because in today's video, I actually want to answer the age-old question. Is it a great idea to be investing in bonds and of course investing in stocks? Is it a good idea or not? But before we go into the video, if you haven't subscribed to the channel yet, be sure to hit that subscribe button, because that's the way how we can grow our community together. And of course, if you haven't checked out my latest book yet, be sure to click the link down below in the description to get your own copy now. Okay, let's get into the video. In this video, I actually shortly want to go through what bonds are, and in this case, what dividend stocks are. Why am I comparing bonds to dividend stocks? Well, in the end, you're actually getting a certain payout every month or every quarter or every half of a year or even annually. This is why I'm actually comparing dividend stocks to bonds in this case. Now, bonds, it's very simple. Bonds is actually a debt. Not from your end to somebody else, like having a credit card debt, but it's the other way around. A certain corporation or the government or a municipality, they actually issue a debt towards you. So instead of saying like, hey, you know what, you buy a share of my company, I'm actually just telling you, you know what, I actually owe you something. So I'm giving you a piece of paper that says, I owe you, which is a method of saying like, you know what, I actually want to do a project and I owe you money. And because you give me money as a corporation or as a government, I will give you interest payment every month or every year or depending on what the period is. So in the end, a bond is a debt and it pays you a certain interest rate over time. And at the end of the period, they will pay you back your initial investment next to every year that they pay out the interest rate to you, which is a way, you know, it's safe, it's secure, but it's not a lot, because in the end, you know, it's like somewhere between 1, maybe 3%, maybe a very high one, 5%. And of course, you've got those junk bonds, but we're not talking about those junk bonds here in this video. But yes, there are like interest rates that will pay you back, but in the end, it's just an interest rate paying you back. Next to that, the question is, what is a dividend stock? Well, we can go high and low and we can go very extensive, but in this video, I actually just want to tell you what is a dividend stock. In the end, you invest your money in a certain dividend stock with a certain price up front, and this could be any price, of course. And then what you do is you invest that money to be able to buy a share of that company. And then what they do is they pay you back a dividend yield, which is kind of similar to the interest rate of a bond, for example. This could be somewhere between 1 to maybe 5% annually. So they pay you that back. But the thing is, with a dividend stock, at the end of the period, so after 3 years, they don't pay you back the actual initial investment that you did. Because with a dividend stock, you actually owe a share of their whole company by holding that piece of paper. So you're not actually being paid back. You're only being paid back through dividend yield. So the only thing is, you only get paid back every year the amount of percentage that they will tell you that they will give you. And that's actually it. You owe a part of the company. Whereas in a bond, you don't owe a part of the company. You actually owe a IOU paper that the government or the corporation gives to you the moment you loan them money. Whereas in a dividend stock, it is not. You actually owe a piece of their company by holding that piece of paper that you have. And that is the first difference. In bonds, they owe you a debt. In dividend stocks, you owe a part of their company. That's the first difference. Now, the second difference is how you make money through bonds and how you make money through dividend stocks. Well, let's start with bonds first. Bonds, it's very simple. So let's pretend that you bought a bond share, which is in most cases around $1,000. So with $1,000, you can buy a share of the bond. Now, the bond says, for example, like, okay, I pay you 3% every year on $1,000. Well, that's $30 per year on interest payment, of course. And at the end of the period, that could be 1 year, 3 year, 5 year, 10 years, 30 years, depending on what kind of bond you bought, of course. Then you bought that for that amount of time. At the end of the period, you'll get your money back, which is $1,000, and every year of interest payment. which is nice, right? And that's how you can make money. But if the interest rates of this year is like, let's pretend just 5%, and this bond that you own is only paying out 3%, well, I'll tell you this, you're most likely gonna switch to the other one. But what happens most likely is that that bond is not $1,000 per share. But because, the demand is high of that bond, they'll raise the amount of that bond. Maybe $1,200 per share on that bond because, hey, there are so many people who want in on this 5% bond. Now, what happens to those 3% bonds? Yeah, everybody starts selling those. So there's no reason for you to hold on to that $1,000 bond that is only paying out 3%. So what you could do is all of a sudden, you could buy a bond which is valued at $1,000. Currently it sells off for $1,200, but it pays out 5% of interest rate, which is nice. But hey, it's more expensive, there's more demand, so the price is a little bit higher. Now on the other end, because the other one is only paying out 3% interest rate, they lower the price to make it more interesting for you as an investor still to say, you know what, I can take the lower interest rate, but the share of a bond is cheaper. Therefore, this is a way how bonds can make you money. That's because the price per share can fluctuate. That's the only way you can make money through bonds. Meaning you do have to time the market if you do want to make a good deal at a good time. But hey, in the end, if you're not looking at bonds, if you're not looking at the prices of the shares, it's totally fine. You can get your $1,000 invested in bonds and you'll get 3% per year. Who cares? Because, if you have $1 million in there, you'll get your 30,000 right away just like that. But with dividends, how do you make money with dividends? Well, there's slightly more to dividends compared to bonds. Bonds are very simple. And they say if you're, nearing your retirement or even if you're in your retirement, the only thing is you put your money in bonds and you know what the outcome is. You already know that you're investing 30 years with this bond and you're getting 3%, maybe 5% of interest rate payment every year. So why did you care? There's no reason for you to care or to worry about. But in dividend stocks, slightly different. So for example, you're still paying $1,000 for one share. For a dividend stock, okay? Still the same amount. What could happen in 1 year time that the dividend stock stays the same amount, so it still stays $1,000 per share? No growth there. No growth on that end. But they could say we pay you dividend yield, which is also an interest rate payment. They could say we'll pay you 4% dividend yield. So every year on owing that piece of paper of dividend stock, we'll pay you 4%. So on 4% on that $1,000, hey, it's still $40 that you get into your pocket every year. Now, dividend companies could pay you in annually or in monthly or in quarterly, it depends on what kind of stock you buy, of course. But the moment you do, you have growth on that end. Now you could use that $40. Now you could buy some candy or anything you want to, but you could also reinvest that $40 into buying the next dividend share. So this year I'm going to buy another $1,000, but I'm going to use that $40 that I got previous year. I'm going to invest that as well. And then all of a sudden that's growing your portfolio as well. And this is a difference there because instead of saying I'm only getting an interest payment, the company itself could grow in value as well. So it's two ends. Not only the price can fluctuate of a share, but you also get growth of the company itself. If the company grows over time, your share will grow along with it. And that's the interesting part. It grows on two ends, whereas bonds don't grow. They stay in value the exact same amount, whereas dividend stocks, they grow on two ends. So you get your dividend payout, and you get the company grow in value. And because there's no end to dividend stocks, the interesting thing is this as well. Let's pretend that you're holding this dividend stock for 30 years time, and you think, I don't want this stock anymore, I can sell it off. If this company is doing a great job over time and has been slowly growing over time, all of a sudden the shares that you own may be valued at $10,000 instead of only $1,000 that you bought it for 30 years ago. And this is the interesting part of dividend stocks. It grows on both ends, and this is how you can make a lot of money if you keep on investing in dividend stocks. Whereas bonds, it's good to invest in bonds, but the only way to make money is what do you pay up front while buying the share of a bond. That's the only way to make money. And next to that, it's just paying out interest rates. And yes, you still have to pay taxes on both stocks. You have to pay taxes on dividend stocks and you have to pay taxes on bonds. So in the end, you're still paying taxes over both of the amounts of money because it's seen as income. And then yes, if you only get 2% on bonds, you're just outpacing the inflation just by a slightly bit. So what's a better idea? Well, that's the next question. Now, the interesting thing is this. When you invest in bonds, the moment a company goes bankrupt, you're the first in line to be paid back. And this is not the case when you're investing through stocks. When you're investing in stocks, you're investing in them. You're one of the last few people that are going to be paid the moment a company goes bankrupt. So yes, owning a certain debt, yes, absolutely. The moment they go bankrupt, you're the first one to be paid out. But I'll tell you this. If you invest in good bonds with a good rating, and of course you can see the rating here on this end. Now, if you have a good bond and not a junk bond, what happens is most likely the governments or these corporations will not go default, will not go bankrupt. So yes, it's safe, it's secure, and it's a 99% sure that you're going to be paid back. But then again, the interest rates are a lot lower compared to the risks that you take the moment you invest in dividend stocks. And dividend stocks, it's lovely because they will pay you out every month or every quarter or every year. They'll pay you back. And with that amount of money, what you can do is you can reinvest the money that you get and you can compound the money that you're invested in a company. And all of a sudden, your value, your money, your investment will grow a lot faster and a lot more. And then again, is dividend stocks a not safe thing? Well, if you know how to choose your companies, for example, a blue chip company, if you know how to pick your companies, if you know how to research your stocks, you'll know which one to buy and to hold on 5, 10, 20, 30 years and then make money over time. And yes, you'll get your payment. The moment you don't want to reinvest the money every time you get from your dividend stocks, you can just use the money from your dividends. All of a sudden, if you own hundreds of shares of that certain company, using that $1,000 every share that you owned, well, all of a sudden, you get a lot of payment just like that. All of a sudden, it could be like $4,000 or $5,000 every month that you're being paid out just like that. And then you can live off your dividend stocks. And hey, you don't have to work anymore. You don't have to worry. You don't even have to worry the moment the dividend stocks end because there's no end date. And this is a reason why I don't like to invest in bonds. I get it. I get it that people say, Lucas, you gotta have a portion of your money in bonds because bonds will save you during a recession. Well, I get it. But I don't plan to take my money out for a long time. So if I don't plan to take my money out for a long time, why should I put my money that what doesn't work very hard? Well, my money can work only once, either in bonds or work in stocks. Well, I'll tell you this, my choice is absolutely in bonds. No, it's not. You get it. Yeah, you get it. Yeah, it's in stocks. Yeah, absolutely. I take slightly more risk, and yes, I'm still at the age that I still can do, but take a look at Warren Buffett, for example. He's 90 years old and still investing in stocks. So yes, I'm absolutely putting my eggs in that basket so that I will make more return. And of course, it's up to you to choose which one you would like to invest in. I thank you very much for watching today's video. If you liked the video, of course, be sure to hit that like button. And of course, if you're not a community member yet, be sure to hit that subscribe button there because that's the way how we will become a greater community here. And of course, if you want to be notified every time a new video comes out, be sure to click on that notification bell as well. Because, hey, then you'll say like, hey, Lucas got a new video. Okay, thank you very much. Happy investing, and I'll see you on the next video. Bye-bye.